Hello, everyone. This is Vikas Gupta, CEO and Chief Investment Strategist of OmniScience Capital. Today, I want to introduce the scientific investing philosophy and framework to all of you. The core of this OmniScience philosophy is based on how we think about investment management in the first place. So, in investment management, there are two kinds of philosophies. One is the business oriented philosophy, where people try to gather assets as much as possible. And on the contrary, we view investment management more as a profession where the focus is on performance. That we want to focus on performance. And if we focus on performance, the ecosystem wins. When performance leads, ecosystem wins. Because, first of all, the client portfolios grow faster. Naturally, the partners also are able to grow faster, and it's a win-win for everyone. So that's our OmniScience philosophy. Uh, Again, the core insight which differentiates us from everyone else, the typical thinking, and which has been taught across academia and the profession itself, is high risk, high return, low risk, low return. But we believe that this is true, but this is true at the asset class level. So a high risk asset class like equities gives high returns, and a low risk asset class like fixed income or debt gives lower returns. But when you come within an asset class, especially equities, then this no longer applies. High risk does not mean high returns, rather it actually means high risk, which will manifest in loss of capital or lower returns. While low risk will is likely to deliver higher returns, and we will explain to you in the next few minutes how this works. So now, coming to the Omni insight on which all of this is based, that most market participants chase alpha or chase returns, and what they end up is with risks. Okay, so the risks manifest in their portfolio, or as the Omni mantra, which is a more concise way of putting this, chase safety to get alpha. Now I'll explain to you how all of this works through the detailed scientific investing framework, which is our investment process. So this philosophy we have encapsulated into a process which can be applied easily, right? So what is that philosophy saying? What is that framework? So let's take any investment universe, right? You could take the large cap universe, which is the top 100 stocks. You could take the mid cap universe, which is the next 150 stocks, or you could take the top 500 stocks as the universe, or you could use a cutoff like 1000 crores market cap and everything above that. So whatever is your investment universe, now there are hundreds of companies or even thousands of companies in that universe, right? Now the question is, how do you select from that? And that is what this framework is designed to do. And in the first step, we are trying to reduce the risks. And when we say risk, we are not talking about beta or portfolio volatility and all those kind of things. That's not risk. That's a risk for a trader. If you are on a day trading or a short term trading kind of a situation, especially with margin money and FNO, short term FNOs, etc., then all of this matters. If you are a long term investor in long only with your own cash capital, not borrowed money, then with a 3 to 5 year horizon, all of these definitions of risk do not make sense. Okay, the definition of risk which makes sense is risk meaning the loss of capital. And for that, if I have to start reducing that risk, I have to look at the company as if it is unlisted. Okay, if it company is unlisted, then what are the fundamental risks which we are talking about? Okay, and the fundamental risk of a unlisted company or even a listed company in truth is that you could lose your capital. How will the shareholders lose capital? That is what we have to think. And if you think carefully, you will realize that if there is a lot of borrowings and you're not able to service the debt, so if there's a lot of debt, you're not able to service the debt, and because of some external or internal circumstances, then the company goes into the hands of the lenders or the bank, and the shareholder is wiped out, right? All the equity is wiped out. So that destroys your capital. So first thing is to eliminate such companies. When you're talking of any investment universe, there are a lot of companies which are highly leveraged, and you want to get rid of those. So these are called capital destroyers. So they could be highly leveraged, they could have consistently loss making, they could be consistently negative cash flows. All of these things are likely to lead to capital destruction for shareholders, and we would like to eliminate this, thus reducing significantly the risk of loss of capital, right? So capital destroyers are out from the universe. Second stage is, even though now all the companies have reasonably strong balance sheets, are reasonably profitable, etc., there are companies where the profitability is low. And what that means is actually that the company does not have a competitive advantage. If a company does not have a sustainable competitive advantage, or what is called in Buffett language a moat, then it's not really worth investing. Okay, it's a high risk company because they are price takers. The customers, the suppliers, everyone is taking advantage of them, and so you don't want to be part of that company. The longer you stay as a shareholder with these companies, your capital is likely to get eroded. And what that means is actually that you will be making lower than market returns. You might be even making lower than the cost of equity capital, or you're not getting compensated for taking equity risk, right? So we take out the capital eroders. So again, now I have capital destroyers out, but your total return has increased while fundamental risk of capital destruction is reduced. Second, I removed capital eroders. Again, your underperformance risk is reduced, right? So risk is reduced while total return of the remaining universe is increased, right? So two levels of risk reduction, two levels of increased returns. Now we come to the third one, where all the balance sheets are now strong, all the companies have competitive advantage, or a very strong competitive advantage, but in many cases the market knows about it, and a lot of these companies get chased by investors and become extremely overvalued. And when that happens, it's not a great investment anymore. So this is where the thing you have to remember is, a great company is not a great investment necessarily. Great company is a great investment only at a great price. So here all the overvalued companies, that's the third bucket, capital imploders, we take them out. So I have taken out the third level of risk now. So the remaining portfolio is much lower risk, three levels, and has three levels of higher returns than the benchmark likely to have. Okay, thing doesn't stop here. So now I have reduced the risk, and now the focus is what is remaining, we call the capital multiplier universe. But from within this, we want to now focus on more returns, right? So now that I have taken out the risks, the three main risks I have reduced significantly, I can focus on the remaining universe, which is likely to be, in India's case, if I started from the full universe, let's say all companies 1000 crores and above, for a typical flexi cap portfolio, that would be around 100 to 150 companies. And from those 150 companies, again, you want to focus on growth, companies which have growth, because companies which don't have any growth, or just about inflationary growth, they are not really worth investing normally. Sometimes it's extremely cheap, it is fine, but in general you want growing companies, and given the growth rate, they are significantly cheaper than the growth rate in the market for some reason, and that's the kind of companies you're looking for. And so that is what we are looking for in the last thing, where we look at exposure to growth vectors, that what kind of growth opportunities these companies have, how long is that growth likely to last, because moat is not going to add much value without growth. Okay, so this is something which most people don't appreciate. They chase moat companies, but moat with growth is what you need. Growth without moat is also not something you want. Okay, so this is the last step, where we focus on the growth vectors. And growth vectors are things which are very long term opportunities, 5, 10, 20, 30-year kind of opportunities for growth, where a company or the whole industry can keep growing for a long period of time, and you want exposure to those things. We look for companies which have a strategy to capitalize on this growth, a very well defined explicit strategy, and that strategy should make sense to us, right? So if all these things are true, then we put them in the portfolio, and a typical portfolio will have 5 to 7 such growth vectors. So the point is that these growth vectors themselves are less correlated with each other. So the portfolio becomes differentiated, and this is growth vector. I'm not talking about number of stocks. So one is the growth vector level diversification. Second, there will be number of industries or sectors within this. And third is the stock level, where we have a minimum criteria of 25 stocks in our flexi cap portfolio, or in some cases, some large or mid cap might have a 20 stock portfolio, a typical diversified portfolio. Uh, would be 20 to 25 stocks, and it could be on the upside, it could be as high as even 35, 40 sometimes, right? So this is the typical portfolio construct, and which we revisit every some period, but typically every quarter once the earnings are out, we have a review of what it is, and the portfolio might be rebalanced if some stocks are overvalued, some stocks are undervalued but are not in the portfolio, they might come in. So when we say overvalued and undervalued, please understand that, as I mentioned, there is a growth vector. So the company has a growth forecast which we want to do on a conservative basis, and given that on a DCF basis there should be a significant discount to its intrinsic value, right? That is what, and when we say significant, it could be 30%, 50%, sometimes even 80 or 90% plus. That's the kind of discount you want, and you want to create a portfolio. And as companies come close to their intrinsic value, and some other companies are available which are not in the portfolio but in the universe, which are significant discounted, then we switch. So typical churn is not very high on a every quarter basis. Rather, on a 3-year basis, I would say most of the companies are replaced around somewhere between 18 months to 24 months, and sometimes even 5 years they might be held, right? So typical churn is not more than 30-40% on an annual basis, but the churn is concentrated either at the peak of a bubble, because a lot of companies in the portfolio have become overvalued and we are getting rid of them, or at the bear, like in the bottom crash, because there we are finding a lot of companies outside the portfolio which we want to add to the portfolio, right? So during those times there is a lot of churn in the portfolio. Rest of the time the churn is very, very minimal. Some years will go by where we don't change practically anything except bring everything in line, because we do a equal weighted portfolio of roughly, let's say there are 25 stocks, then 4% each. The advantage of 4% or 3% kind of thing is that, first of all, because we have reduced the risk on a fundamental basis, the chances of it crashing significantly or going to zero is very low. But even then, even assuming it goes to zero, that's 96% of your portfolio is still going to be surviving and delivering returns. So the risk, the tolerance of your portfolio to a black swan event in a specific company is extremely high. So I hope you have understood our scientific investing framework and how it is able to reduce risk at least 3 levels and increase the returns at the same time. Okay. And if you have any queries, reach out to us. Thank you.